Foreign direct investment, FDI, refers to the process by which a company or individual from one country invests directly in assets or businesses in another country, to establish lasting interest and influence. This type of investment usually involves acquiring significant stakes, establishing subsidiaries, or forming joint ventures in the host country. FDI is a vital engine for economic growth and development globally. It brings capital, technology, job opportunities, and expertise to the host country while offering companies the chance to expand their markets. However, it also comes with challenges, such as market domination by large multinational firms and environmental concerns. What is FDI? Foreign direct investment, FDI, refers to the investment made by a company or individual of one country into business interests located in another country. This investment typically involves acquiring a significant stake in a company or setting up new business operations such as subsidiaries, joint ventures, or branches. FDI is different from foreign portfolio investment, FPI, because it involves a long-term interest in the company's management and operations, rather than just trading shares or securities. FDI types. FDI can be categorized into three primary types: horizontal, vertical, and conglomerate. Each type reflects the nature of the business relationship between the investing company and its foreign counterpart, and the level of integration between their operations. Horizontal FDI. In horizontal FDI, a company establishes the same type of business operation in a foreign country that it runs in its home country. For example, a U.S.-based fast food chain, such as McDonald's, might open new outlets in France, expanding its business in the same industry and offering similar products. Vertical FDI. Vertical FDI involves a company acquiring a complementary business in another country. This often happens when a company invests in a foreign company that provides essential raw materials or components. For instance, a German car manufacturer like BMW might invest in a foreign company that produces specialized car parts, thus securing a steady supply of components for its assembly lines. Conglomerate FDI. Conglomerate FDI occurs when a company invests in a foreign business that is unrelated to its core operations. This type of investment often takes the form of a joint venture, as the investing company typically lacks experience in the new business area. For example, a U.S.-based technology firm like Apple might invest in a foreign fashion brand, which is outside its main industry of consumer electronics. FDI methods. Foreign direct investment can be undertaken through different methods. These methods, commonly referred to as greenfield and brownfield investments, reflect different approaches to entering foreign markets and expanding business operations. Greenfield investment. This method involves establishing a new operation or business from the ground up in the host country, such as building new plants, offices, or manufacturing facilities. This allows investors to have full control over the business's setup and operations. Brownfield investment. In contrast, a brownfield investment occurs when a foreign investor acquires or merges with an existing company in the host country. Rather than starting a new business from scratch, the investor uses existing infrastructure and operations to expand their presence in the market. FDI factors. Several factors influence the decision to invest in a foreign country. These factors help determine whether an investor will choose to commit significant resources and establish a long-term presence in the host country. Some of the key factors include market size and growth potential. Countries with large and growing markets tend to attract more FDI as companies look to tap into new consumer bases and expand their operations. Political stability. Investors seek countries with stable political environments, as this reduces risks related to policy changes, expropriation, or social unrest that could affect their investments. Legal and regulatory framework. A clear and investor-friendly regulatory framework, including well-defined property rights, tax incentives, and transparent governance, can encourage foreign investment. Infrastructure. The availability of high-quality infrastructure such as transportation, telecommunications, and energy plays a vital role in attracting FDI, as it reduces operational costs and increases efficiency. Cost of labor and resources. Countries with a skilled workforce and affordable labor costs are attractive for companies looking to set up manufacturing or service operations. Ease of doing business. Investors are more likely to invest in countries that have streamlined processes for starting businesses, acquiring permits, and repatriating profits. FDI significance. FDI is an essential driver of economic growth and development for both the investors and the host countries' economies. The key significance of FDI includes economic growth. FDI boosts the host country's economy by bringing in capital, creating jobs, and enhancing technological advancement. Infrastructure development. FDI often leads to the development of new infrastructure, such as transport and energy facilities, which can further enhance economic activities. Transfer of technology and expertise. It facilitates the transfer of advanced technologies and management practices to the host country, improving productivity and efficiency. Increased exports. FDI often results in the increased production of goods and services that are exported to other markets, benefiting the host country. Job creation. Foreign investors create job opportunities in the host country, which contributes to lowering unemployment and raising living standards. Tax revenue. The profits generated from FDI help boost corporate tax revenues in the host country. FDI in India. India is one of the largest recipients of foreign direct investment, FDI, among emerging economies, offering several advantages like a growing consumer market, a skilled workforce, and favorable government policies. The framework for foreign investments in India is governed by specific laws and regulations that facilitate and regulate FDI inflows. FDI definition. An investment is considered FDI if it involves acquiring at least 10% or more of the post-issue paid-up capital of a company. Primary legislation. The Foreign Exchange Management Act, FEMA, governs FDI in India, defining the regulatory framework for foreign exchange and foreign investment. It is administered by the Reserve Bank of India, RBI. Consolidated FDI policy, issued by the Department for Promotion of Industry and Internal Trade, BID, under the Ministry of Commerce and Industry. It outlines rules, guidelines, and procedures for FDI. Cumulative FDI inflow. Since 2014, India has attracted a cumulative FDI inflow of $667.4 billion, 2014 to 24. Top FDI sources, in the FI 2023 to 24, Mauritius, 25%, Singapore, 23%, USA, 9%, Netherlands, 7%, and Japan, 6%. Are the top 5 countries for FDI equity inflows into India. Top sectors. The top 5 sectors receiving the highest FDI equity inflows during the fiscal year 2023 to 24 are as follows: services sector, including finance, banking, insurance, with 16%, computer software and hardware at 15%, trading at 6%, telecommunications at 6%, and the automobile industry at 5%. FDI routes. India allows FDI through 2 routes, automatic and with government approval. Automatic route. FDI under this route does not require prior approval from the government or the Reserve Bank of India, RBI. It is permitted in most sectors, subject to certain conditions. Government route. For sectors where FDI is subject to government approval, investors need to seek permission from the government before proceeding with their investment. FDI categories. The foreign direct investment, FDI, limits in India vary by sector and are based on the sensitivity of the sector. Following are the FDI limits for different sectors in India. Sector FDI limit. E-commerce, 100%, automatic route, in marketplace model e-commerce. FDI in inventory-based e-commerce is not allowed. Civil aviation, maintenance, repair, and overhaul, 100%, automatic route. Railway infrastructure 100%, automatic route. Print media 26%, automatic route. Private sector banking, 49%, automatic route. Up to 74%, government approval. Pharmaceuticals, 100%, automatic route, in greenfield projects. Up to 74% in brownfield projects. Defense, 74%, automatic route. Up to 100%, government approval. FDI prohibited sectors. There are certain sectors in India where FDI is either prohibited or restricted. These include lottery business, chit funds, trading in transferable development rights, TDR, manufacturing of cigars, cheroots, cigarillos, and cigarettes, tobacco or tobacco substitutes, gambling and betting including casinos, the company, real estate business or construction of farmhouses. Sectors not open to private sector investments, atomic energy, railway operations. FDI outflows. FDI outflows refer to the investments made by Indian companies in foreign countries. It has been steadily rising as Indian businesses seek to expand their global footprint. It comprises three key components: equity, loans, and guarantees. Cumulative FDI outflow. According to the Reserve Bank of India, India's outward foreign direct investment, FDI, commitments saw significant growth, rising to $3.24 billion in October 2024, up from $2.55 billion in October 2023. Top destination, Singapore, due to favorable business environment and strategic location in the Asia-Pacific region. FDI vs FPI. While both foreign direct investment, FDI, and foreign portfolio investment, FPI, involve foreign capital entering a country, they differ in terms of the nature of investment and the level of control exercised by the investor. FDI typically involves a long-term interest and significant influence over business operations, whereas FPI is more focused on short-term financial gains through the purchase of securities. Nature of investment. FDI involves long-term, hands-on investments in businesses, while FPI is more passive, involving financial assets like stocks and bonds. Control. FDI grants the investor significant control over the company's operations, whereas FPI investors have no such influence. Risk and return. FDI carries higher risks but offers potential long-term returns, whereas FPI tends to be less risky and focuses on short-term gains. FDI criticisms. Despite the numerous benefits of FDI, it is not without its criticisms. Concerns have been raised about the potential negative impacts on the host country's economy, environment, and local businesses. Critics argue that, in some cases, FDI may prioritize foreign interests over local development. Key criticisms include market domination. Large foreign firms may dominate local markets, pushing out small and medium-sized enterprises, SMEs, and stifling competition and innovation. Profit repatriation. The profits generated from FDI often get repatriated back to the investor's home country, limiting the long-term economic benefits for the host nation. Exploitation of resources. Critics argue that foreign investors may exploit local resources, labor, and markets for profit, often leaving minimal benefits for the host country. Regional imbalance. FDI tends to flow into states with existing infrastructure and better business environments, leading to regional disparities. For example, states like Maharashtra and Gujarat attract significant investments due to their advanced infrastructure, while other states may be left behind in terms of development. Environmental impact. Some FDI projects, particularly in industries such as mining and manufacturing, may lead to environmental degradation, with little regard for sustainability. Cultural influence. Large-scale foreign investments may lead to the erosion of local cultures and practices, as multinational companies often push for uniformity in products and services. FDI UPSC PYQs. Question 1. Justify the need for FDI for the development of the Indian economy. Why is there a gap between MOUs signed and actual FDIs? Suggest remedial steps to be taken for increasing actual FDIs in India. UPSC Mains 2016. Question 2. Though 100% FDI is already allowed in non-news media like a trade publication and general entertainment channel, the government is mulling over the proposal for increased FDI in news media for quite some time. What difference would an increase in FDI make? Critically evaluate the pros and cons. UPSC Mains 2014. Question 3. Foreign direct investment, FDI, in the defense sector is now set to be liberalized. What influence is this expected to have on Indian defense and economy in the short and long run? UPSC Mains 2014. Question 4. Discuss the impact of FDI entry into the multi-trade retail sector on supply chain management in commodity trade patterns of the economy. UPSC Mains 2013. Question 5. Though India allowed foreign direct investment, FDI, in what is called multi-brand retail through joint venture route in September 2012, the FDI even after a year, has not picked up. Discuss the reasons. UPSC Mains 2013.